$5,000, right? Should you do lump sum investment? That means invest this $5,000 in one shot, or should you break down this $5,000 into smaller amounts and dollar cost averaging them? I'm Alvin, founder of Dr. Wealth. Today we're going to talk about a very common question. Vanguard, which is one of the world's biggest fund managers, did a study comparing whether lump sum investment and dollar cost averaging, which one is actually better for investor. And let me just break it down for you. So, for example, they were saying that if, let's say, the market is on uptrend, it's definitely much more worthwhile to do a lump sum investment. So, for example, if you bought at $1,000 and it continued to increase to $2,000, of course it makes sense to put all your money at the start as much as possible. If you break it down, if you invest, let's say $100 every month, right, it gets more and more expensive and you buy less shares over time. So, which means on the uptrend, it's definitely better for you to do lump sum investment. You get a higher return at the end of the day. The other scenario, which is a downtrending market, it makes much more sense for you to do dollar cost averaging, because the reverse is true. If the prices is getting cheaper and cheaper, it makes sense for you to delay your investments such that your future investment is going to buy more shares for the same amount of money you purchase. Okay, and what they have found, Vanguard, is that 2/3 of the time, lump sum investment did better than dollar cost averaging. And the other 1/3 of the time, dollar cost averaging did better than lump sum investing. And it's actually very intuitive. You do not need rocket science to understand this part, because most of the time the market is in an uptrend, all right? And few times when the market crashes, it goes down in a very, very sharp correction, and it's very fast and very short-lived. So, for example, a typical bull run can last 7 years to 10 years or even more, right? Whereas a market crash will probably last about 1 year to 2 years. So, which means most of the time it is an uptrending market, and we learned that uptrending market you should do lump sum investments. So, which means some of you might be thinking, if I am going to decide whether I should do lump sum and dollar cost averaging, I need to guess where the market is going, right? So it's a big no, which nobody is able to accurately predict the future direction. So in other words, it's almost impossible to know, right, which direction we're going, and therefore which method we should be doing. So it is not a matter of direction catching, right? So what I will advise, or what I will suggest, is that whether you should do lump sum and dollar cost averaging, it depends on the availability of your capital. Okay, so if let's say you already have quite a sizable amount of capital that you invest, it makes sense for you to just do lump sum investment rather than dollar cost averaging. But on the other hand, let's say you're just starting work and you have a small amount of capital, and you have a regular income stream, so you are more suitable to do this dollar cost averaging. So I'll emphasize that for your choice of lump sum investing versus dollar cost averaging, it should anchor on the fact that how much capital do you have available for investing. Okay, so today is a short video on this topic, lump sum investing versus dollar cost averaging. I hope you get a better idea what to do after this video.